This is Jordan with Conquer Trading and Investing. If you're new here, welcome. And if you're not, welcome back. Looking forward to today's session as I am each and every day. Today, we're going to talk about narratives. Narratives are really fun. They're really easy because they make people feel comfortable. People like to feel comfortable. People like to have some type of certainty that they know what is going on. Only the markets are a little bit, or should I say a lot more complex than that. What do I mean by that? The current narrative right now, from the best that I could share it with you, is that the Fed is tightening and they're going to continue tightening until something breaks. And that seems pretty like, all right, I got that. I could deal with that. Now, the same people that are rightfully, when I say rightfully, I mean that is correct. The Fed is tightening and they are going to continue to something breaks, but it's a lot more complicated than that. But now the same people who are really honing in on that message, you have to go back to last year, 2021, when the Fed pivoted, Fed pivoted towards tapering their asset purchases, that winding down their QE purchases. Do you remember for months as the Fed was winding down their purchases, everyone's like, oh no, look at the balance sheet is still increasing. Do you remember that? It was everywhere. Do you remember here at CTM, we were like, no, listen, of course it's increasing. They're still making quantitative easing purchases. They're still buying assets. It's only that it's lessening month over month until it stops around March. Do you remember that people not only said that, well, the balance sheet is still increasing. Many of the same people, the ones that are the most vocal right now regarding the tightening that's taking place and its end result, were also the most vocal that the Fed was lying and the Fed was not really winding down their balance sheet. Now we come to a point in time, you have to ask yourself around that time, what was the messaging? Was it correct? And then you have to ask yourself right now, what is the messaging and is it correct? There's a lot of people who are really able to see what's going on in the moment and then really catch up to it and articulate it and hone on it. And it's really good communication in the sense that people are comfortable with it and like it. Very few are able to be out there and forward thinking, right? There's some great macro analysts out there who are forward thinking. They're always adding to the conversation, trying to figure it out in real time. And these people from time to time will obviously be wrong. But guess what? They're also constantly reevaluating their own analysis. We live in a very complex time, a very complex world. It's not that easy. The title of today's session is The End of the Liquidity Supernova. Patrick, everyone, Lee, great to see you in here this morning. I hope you're all doing well. Do you all recall yesterday John's call about the intervention potentially taking place by the Bank of Japan? Did you see that? We'll follow up on that in just a bit. Let's continue with this morning's beginning of the presentation. And we're talking about the end of the liquidity supernova. If you go back just a couple of years, back into 2018, this is 4 years now, you had the general consensus out there was that as the Fed is raising rates, as that the Fed is beginning or in the midst of their quantitative tightening program, pulling away liquidity. Forget expanding their balance sheet. And by the way, the greatest signal in the markets is the continual expansion of the monetary base by the Federal Reserve and the central markets. And it's actually the only way to keep this Ponzi going. It's the only way to keep the dollar debt-based system going. It's just math. And it's true. And right now, while they're pulling away liquidity, they will continue to do so until something breaks. And the last time that was talked about and people were talking about it's over and things are going to break, it was in May 2018. Do you remember, are you familiar with what happened since May 2018? Let's go pull up a chart. I like to go ahead and talk visually. We'll start here with the S&P 500. Let me take off this stuff over here so we're just looking at pure price and price alone. And we're going to just come back over here. And this is over May 2018. And this is where the prevailing market thought at the time was that the Fed is pulling away liquidity. They're going to continue tightening until something breaks. And a funny thing happened along the way, right? And you could see that, well, the S&P went on to make new all-time highs. And then we had into the third and fourth quarter of 2018, this was I remember it very well. I remember being right around Christmas, being with my father-in-law, around Christmas time and talking to him and telling him, for him, probably the best thing to do was lean into Apple at that particular point in time. There was no fear. Well, maybe there was fear out there, but again, we had messaging from the powers that be. If you remember, Treasury Secretary Mnuchin met with all of the CEOs of all of these banks and was like, listen, we need to do something. The president at the time was like, look, this is probably a good time to buy stocks. I think that we had people that were trying to communicate very well. I don't, for myself and from my vantage point, there was a lot of clarity. There wasn't any type of fear. And then the markets, you could see that they went on and they made new all-time highs. This is why QT is running, by the way. This whole period over here, QT is running and the Fed is tightening and nothing broke. Remember, people thought things were about to break over here in May 2018. People today that think that things are about to break, potentially they are correct. Eventually, things are going to break. It's the timing between now and when things break that is the hard part. And I'm trying to point to you out how difficult it is in real time to get that timing correct, because it really wasn't until March 2020. It wasn't until a virus was spreading around the world and the world went on to global lockdown that we saw things break. Now, that could happen. There are many potential hotspots around the world. You don't need me to give you any type of idea about something that could go bad and wrong and really quickly. It could happen each and every day. I remember what it was like waking up on September 11th, 2001. I remember that whole thing very clearly. I remember the world had changed that very day. I remember what it was like watching and preparing for what happened in that early 2020. I did it with all of you together. Right now we look and people analyze and they think that they understand what's happening as wars are being fought and what the next moves are going to be. And yes, they could be horrific. We don't know, and it could happen any day. But these things are always in the psyche, in the back of people's minds, and they're always constantly, it's the climbing of the wall of worry. Generally, if you have an optimistic stance, optimism generally wins. Now, not always. We want to be prepared. I know that when the markets did crash over here, that we were early on it. I hope that if we run into any type of crash, that we are also able to, in real time, be able to go ahead and make sure that we are on top of it. It's not easy, and I don't think that anything's easy about it. I actually think that this time is harder than any other time out there. So we're going to remember, and that's why I'm bringing this up. The reason I'm bringing this up, because it's very easy for you to fall into the trap that, okay, well, things are going to break. The Fed's tightening, things are going to break. Well, 4 years ago, the same prevailing thought, only markets went on to rally to not only to new all-time highs, but drastically higher. And guess what? Because it is a Ponzi scheme, the Fed had to go ahead and lean into the balance sheet. I don't know if you had the opportunity to take a look at this. This is actually the monetary base total of the Federal Reserve. And I'm looking at just since 2010. And you could see these highlighted areas of these expansion of the balance sheet. You could see these highlighted areas of when balance sheet expansion was taking place. And it's not taking place right now. Right now, they are pulling away liquidity. It's really neat if you go ahead and you line up a price of Bitcoin with that. And you could see that each and every epic bull market of Bitcoin has coincided with the expansion of the Fed's balance sheet. Now, I know people like to view Bitcoin in regards to M2. I think that's faulty. I think that's erroneous. It doesn't give you any type of signal. Signal is an edge in the markets to know when something, look at the expansion taking place in the balance sheet, look at Bitcoin run. Is the Fed expanding their balance sheet right now? No, Jordan, they're contracting it. Should we expect any type of like sweet spot of the bull market now? No, not even close. It'll be very clear when that time is lining up. Let's go back and continue just to follow these again, expansion of the balance sheet, bull market run. And this right here is signal. You could see again, expansion of the balance sheet, bull market run. Right now we're contracting. It's very interesting to know also, by the way, that the degree of the contraction that's taking place right now, it's roughly a 13.5% reduction of of the monetary base total. And you're seeing Bitcoin off roughly, let's call it 65%. This is on a monthly closing basis. We all know it came off 75%. And then you go back to the top in 2018 and you see the balance sheet off 12.5%. And you see the reduction in Bitcoin in kind. Now that says to me that if they keep going and they go much further, that yeah, there could be much more, let's say, pain on the downside. I don't even want to say pain, movement towards the downside. There's no question about that. The one thing that's not so easy about all of this, the one piece that's a little bit tricky, and when I say easy, yeah, anytime the Fed's balance sheet is being expanded, well, that seems to me to be pure signal. That is right there, like Bitcoin is an inflation hedge. Yeah, but you have to be able to time when the Fed is going to, this is much more of a signal. The contraction, when did this start contracting? Jordan, it's the peak was in November 2021. When was the peak of Bitcoin? All right. What about over here? When did we start contracting? Well, we started contracting in December 2018. Jordan, that's not working out so well. Where's December 2018? Over here. What about over here? Here we had an expansion. Here it didn't coincide with the peak. And neither do the bottoms. Neither do the bottoms, because where did Bitcoin bottom out? Bitcoin bottomed out in December 2018. And then you could see from over here, the balance sheet continued to decline. Bitcoin during that period, remember QT was running in this area over here from December 2018 through September. So where am I? September 2019, right there, the bottom. You saw QT running and Bitcoin do a 4X. So what's going on there? It's a lot easier to know when you're seeing the actual expansion of the balance sheet taking place in force. That is the time to be fully positioned in and more into Bitcoin. The bottom parts are not so easy, and they never have been in any one of them. Bitcoin is always rallied before the balance sheet begun expanding. How do you get that timing right? Well, that's why we have to lead into other things. I mean, it's look, I said it from the very beginning. There's nothing easy about it. It's all very complicated. Take a breath. Hold on. When you come down from your sugar high, do you think you could go to baseline? You go below. No. So good morning. Great morning. I'm happy to be here with you all. I have drive. You just drive guitar. My brother, thanks for being here each and every morning. I don't even know how to go with that. I'm just going to let that go like, I guess, water off a duck's back. But I have chronic Lyme and I'm not able to have sugar high or anything that you think. Or I'm here enjoying being with you all. I'm here and it's a joy to be able to share my time and talent with you. But I really believe in mutual respect. I really do. All right. So anyway, let's jump back and get back into it. It's a discernment process on both sides. There's no question about that. I got to go ahead and foster the best environment for not only for me to get up to be able to work with you all, kiss the kids, get them ready for school and jump on here, At the same time, it's got to be a conducive environment, a positive and supportive environment. It's the best way to work. It's the best way to thrive. And I do really wish for conversation on all different sides, especially pushback from prevailing thought and theories, especially when they're mine. I really do enjoy consulting all sides. I want to know where I'm wrong. I have done a great job, I would say, over these past 24 years in constantly trying to be a student of the market, constantly trying to improve on myself. And there's always lessons to learn. In the past, let's say year and a half, I've worked very hard at being open to all vantage points. And especially when someone's view is polar opposite to mine, I really want to know and understand that. And then, you know what? I'm also much more hesitant to even take a view, especially in these times. Anyone that's claiming to have the clarity and the truth, I'm very cautious about that. I don't think that the world has ever been in this current environment. At least people that are alive right now, we're undergoing monetary reset. I think it's very complicated, and I think that I'm glad to be here with all of you as we go through this. I think that is going to be very, very helpful. This is from that same time over here in May 2022, and you're looking at Bank of America pointing out, well, well, Bitcoin was in the greatest bubble ever. It went from 300 to 19,600 in 3 years. I mean, you could look back and Bitcoin went to 69,000. Was that the greatest bubble ever? And it's a lot of the same rhetoric that you saw back then that you are seeing now. And it brings caution to about how much further this current until things break is going to be. It is true, many months ago, many people thought that things would have already broken. Now, yesterday, maybe we did see signs that things were breaking. Yesterday, we saw the Bank of Japan was warning of imminent FX intervention. Now, they didn't, from what we've seen, understand, they didn't actually intervene yesterday, but they kind of gave the market like a check, a signaling that they might be getting ready to go ahead and intervene into the market. And we saw, and let's pull up a chart of it and let's look at the charts as we talk about it. And we saw briefly the Japanese yen just put in, like, during that check, a little, or big, nice move, I should say. Let me pull up US dollar, Japanese yen and get into it. Drop down over here and come down to our 8-hour time frame. And we saw off the move yesterday. We saw that slam down the Japanese yen. Now, again, no intervention has yet taken place, but the Bank of Japan is setting up for a potential intervention move. I saw some investment bank pointing that if that takes place, that they place the cross somewhere around potentially moving down towards 137. But what is most interesting, and you could see that each time we've seen intervention from the Bank of Japan. Let me come down over here. In this area over here highlighted in red, these are when Japanese yen buying has taken place by the Bank of Japan. Now, this is only when the Bank of Japan is acting unilaterally. Generally speaking, in today's world, for any type of intervention to be successful, the Plaza Accord, you need central banks working together in unison. It is potentially possible because before the Bank of Japan acts, they would need permission of the Federal Reserve, of the U.S. government, to go ahead and act into the market to intervene. Assuming that permission is granted, we saw that Janet Yellen about 4 or 5 weeks ago was very clear that they are working closely together with the Bank of Japan, that permission would be granted. It seems to me that it is generally been not a long-lasting move. The macro forces at play right now, as the Fed continues to actually raise rates, as we see the bond market in the U.S. continue to rise, is putting massive pressure not only on the Bank of Japan, but specifically their credit markets. It seems to me that any type of near-term intervention would kind of clear out the field. A lot of people right now, or a lot of funds, are speculatively attacking the Bank of Japan. They're long US dollars, short yen. They have to go ahead and kind of like reposition themselves. But don't be very careful about entering a trade. Like right now, all they did yesterday was clear out a lot of speculative shorts on the Japanese yen. At the same time, be very, very careful anytime that you are positioning around any type of central bank intervention. You can't trust them. If you remember when the Swiss franc was intervening in the market and they were holding a peg, the Euro Swiss franc, and then one day they just decided to let the peg go. Yeah, I think we came off like 20% in a day or something close to it. A lot of people lost a lot of money. You got to be very, very, very careful. Boom. Kevin, John, Rob, everyone. That was beautiful times. I mean, beautiful times in that we had each other. There's no question about that. And I have a feeling that we could be setting ourselves up for some peculiar times ahead. I just want to make sure that we have that whole foundation in place. Let's keep going. Let's get into the charts a little bit. There's a couple more things that I wanted to mention before we do, and just pointing out that as we look at the expectations for the Fed funds, terminal rate continue to rise in unison. We're looking at subsequent rate cut expectations continuing to climb. And the reason being it and for it is this beautiful chart over here that is indeed the Fed will continue hiking, or I should say tightening, right? Because if you remember, they did it. Just want to, for all those that are new here, I just want to throw out there that in my own opinion, the actual rate hiking cycle, the raising of the rates, the pausing, and then the cutting is much more, or a paramount signal to then the balance sheet runoff taking place, the quantitative tightening. The reason I say that in most simplistic terms, and it's only one cycle of quantitative tightening that we had that we could look at, but it was the last rate hike occurred in December 2018. The market rallied off of the rate hike. It wasn't the Fed saying we're going to pause. It wasn't a rate cut. It was a rate hike that risk bottomed and began rallying. A few weeks later, the Fed verbally pivoted and they said, okay, we're done raising rates. And that was the official pause. But the market already priced that in. That same day on TV, Paul Tudor Jones got on TV on CNBC, and he said the Fed just made a policy mistake. That will be their last rate hike. The market is indeed forward looking. You got a taste of that in June. You got a taste of that off of that 9.1 CPI reading that followed. That was the market saying they thought. Now, that was corrected this past week. We're data dependent. At the time, the market perceived that as potentially inflation peaking out for the near term, for the intermediate term, right? And then the markets put in a June low and began rallying and extended that rally in July when we had an 8.5% CPI reading. It was a sign inflation was coming off. Now we saw the markets really reprice this week when we saw that core inflation was continuing to rise. It's very worrisome that the one thing that was coming off in inflation is energy. And it's very worrisome because the reason it's coming off, could it be because we're headed towards recession and demand is down? I mean, lots of China's offline. There's no denying it, right? We saw China's consumption of oil for the first time in, I don't even know how long it was. It was a really, really, really long time come off. So there's less demand out there, but there's also obviously everyone's aware of the United States. They are selling or I should say letting go, selling the Strategic Petroleum Reserve. And then this week they're talking about, well, we may begin refilling it. Before I look at oil, let me just take a quick look over here at what's going on with the euro, and not too much. Lots of consolidation over here, waiting, it seems to me, waiting on what the next move out of the Federal Reserve is going to be. This is what we're setting up for any type of continuation here on the short side. Would you be willing, ahead of next Wednesday's FOMC, to get into a short position? What are you thinking? Think ahead. Don't look at the charts today and say, what could I get into? First of all, that's the greatest mistake any trader can make. If that is your plan, that's a red flag. That's great to be able to have that self-awareness to recognize that's just wrong. That's a great place to be because you could get what's right. Before ever executing any trade in the market, you need a plan. If you don't have a plan, that's fine. You need to work out a plan. That's where your time should go. That's where you should spend an hour a day developing a plan, right? Trading in the paper markets. Anyway, let's go back and take a look at what else is going on over here. I want to flow over, and I said I wanted to check out what is going on with oil. Jumping over and checking out WTI. And interesting, right? Oil on the back foot, even though President Biden has made it known to the world that they plan on potentially begin refilling the Strategic Petroleum Reserve at around $80. That there, does it put in a price flaw? We talked about or mentioned yesterday that maybe not, right? That I would expect it to come off a little lower than that, but that overall, let's just continue watching for oil. I'm talking about. Let's continue watching until it's very clear, because you have to look at, if inflation is going to be double digits in 2023, how do you position for that? I think, personally, food and energy is probably a really good way to position for that. Do I think this is the right time to buy into energy, to oil? I don't. I'm stalking it. I'm watching it from afar. I'm not even lined up or have it lined up. When it's lined up, we'll flag it with a green dot on it. But right now we continue to get that feel. We watch our enemy and we continue to stalk it, and that's where we are. I didn't get a chance to look at gold yesterday, so I will. But before we do, let's just look at what continues to develop on silver. And it looks out of what was set up over here as a potential long entry, right? We flagged that on Friday, then on Monday triggering. It looks like over here we're seeing a bit of a pendant forming, right? And you can see it like that. We'll continue set up and watching. I think right now that the stop loss move from entry should be moved to a tighter stop loss, and defensively. And I say defensively because ever since we've seen that CPI, we've seen that current risk rally that was taking off and very sharp. That risk rally began last Monday when the Federal Reserve leaked to the Wall Street Journal that they would be raising rate hikes 75 basis points. And risk rallied on that sharply. Why? Maybe the market felt that, well, I take the Fed at its word. When the Fed says that the market could handle the tightening, maybe the Fed means that. I say it's very difficult, and it's very difficult because the messaging you hear is don't fight the Fed. Well, what does don't fight the Fed mean? When Jerome Powell said that he feels in the last FOMC press conference that he feels that we're getting ready to the neutral rate, did you believe him? Do you take him at his word, or are you fighting him? Right? And you remember the market didn't fight him. All of a sudden, the market began front running that next pivot of the Fed. And then all of a sudden, all these tightening conditions in the market were eased. The Fed didn't like that. The Fed did what it does best. It pulled out its tool, the verbal intervention. It had a whole host for 8 or 9 days of Fed speakers. Very, very hawkish leading up to Jerome Powell and Jackson Hole, who then went ahead and smashed down the hammer. And even though he had a Freudian slip a couple of weeks ago, he changed the messaging. They didn't do anything different. They just changed the messaging. Anyway, so the markets have been on the back foot, right? The markets ever since the CPI have gone ahead, and we saw that risk rally taking place, all of a sudden reset. But why that's happening, when I look at silver, I say, all right, well, it's come off, but it's still holding up relatively well. So we might get an extension out of here, right? We might get an extension out of here. By the way, I say to be defensive. The way that I'm viewing it is be defensive and move the stop loss below this swing low over here. Now, the way that it's normally done for my own position management in this style would be to go ahead and move the stop loss to break even. And on a breakout back above towards a resumption, I would go ahead and then move the stop loss to lock in the profits. I feel like being a little defensive right now only because the market is quite defensive over here, right? Now, you can see on the S&P, well, we're kind of holding that support, right? And if we lose that support, we're coming back towards this area of supply, right? Between 38, I don't know if you could see, let me zoom in a little bit and be more mindful to zooming in a lot more. In between this area I have highlighted as support, the yellow line, by the way, that's that pre-journal, Wall Street Journal leak low, right? And price is still above it roughly a week and a half later. So interesting. If we look at what's going on the NASDAQ, remember I kept that question mark there at the end of our yesterday session, and I don't think that I should move it yet, only because the S&P 500s give me a little bit of a read, right? And the S&P still continues to hold that support over there. So I don't know whether or not I should be moving this down or keeping it where it is. I'm trying to figure it out in real time, and I'm trying to pay attention to the market, and the question mark still remains for myself. When I talk about the market moving in towards that risk off, I see signs that are showing things a little bit different. What do I mean by that? Let me go ahead and show you. And I look at the cross. I look at the gold to silver cross. And you can see silver over here is on the win. Let me go to a higher time frame with you all. All right, you could see this is not a risk off positioning. If it's risk off, you'll see gold, the gold to silver ratio really climbing. Let me show you what it was like in crisis, right? And this is coming in towards when you're looking at crisis. And you could see that move into gold, right? Do you want to, in the midst of any type of liquidity crunch, Do you want to be holding silver or do you want to be holding gold? It's almost a very easy play. I don't know if it's the best play, but it's a very easy one. Let's take a look in percentage terms at what it is and just go ahead off of the crisis really started by the end of February. We were already begun positioning for it. So I'm going to come over here off of the top of that swing high. I mean, that's an enormous move. I'm interested what that looks like on Bitcoin versus gold as well at that same particular time. So let's jump over there and take a look together. And that was right over here, right? And just to get an idea, not even comparable. I mean, in all fairness, we did see the massive BitMEX. It was the largest exchange at the time, and it went into just a massive liquidation feedback loop. It was like a death loop, a death spiral. It could have took Bitcoin down to zero, but BitMEX went offline for maintenance, and then it snapped back. And I just want to see where that printed out. That was on the 12th, and I want to see where silver peaked. All right. See, silver peaked on the 18th. So that had a lot. This is just my own opinion. That had a lot more to do with the what occurred on BitMEX. And I don't know. I feel like this is the safer trade, gold versus silver. I think that the more Bitcoin matures, there's going to come a point in time when we look at the amount of people holding Bitcoin for a year or longer, right? There's going to come a point in time when they're not going to let go of their Bitcoin. So in any type of situation like this, there will actually, the people that have to sell Bitcoin because they're getting liquidated and they have no choice, well, that's on them, and that's going to happen. But there's a whole army out there who are not letting go of their Bitcoin. I think that Bitcoin, why it could have some exasperated moves, it's gonna, on both sides, it could snap back just as quick. When I look also at the cross, though, of Ethereum and Bitcoin right now, that's also not showing me right now that the market is in risk off. This is showing risk on. If I look at the cross of gold and silver, it's showing me that right now risk is on. If I look at the cross of Ethereum, Bitcoin, it's showing me risk on. You can see this is risk off, right? Into the lows of June, we were really seeing risk off. I know Luke has showed us a chart of high yield credit, and at the same time, right now, it's not also showing us signs of risk on that we were seeing just a few months ago. So what to make of that? I don't know, but observations are the best way to get to any type of clarity. Just by observing what's happening in the market, you are able then to, over time, layer it on to things become clear. But that's interesting. I believe that's something that's interesting that's taking place in the market. Not that the talk of intervention from the Bank of Japan is not interesting as well. It's very interesting, something for us to continue watching. If that happens, that could take some near-term pressure off of the dollar or the dollar index, I should say. Now, it's interesting that the Bank of Japan set that up yesterday. By the way, again, huge hat tip to John, recognizing that during our session yesterday in real time, before any news announcements came out about it, just watching the price action. That was really, really clever. The next week, Fed's getting ready for a rate raise, a rate hike. Market right now pricing in 75 basis points. And that's drastic repositioning. Just a week and a half earlier, it was only pricing in a 50 basis point hike and roughly 50-60% chance of a 75 basis points. Now we're pricing in 100% chance of a 75 basis point hike, and then roughly somewhere between, last I checked, it was even as high as 38% of a 100 basis point rate hike. Let's see what happens over the weekend if we see any type of communication from the Fed through any type of back channels on whether or not they're changing in just a week. But the CPI came out, so that was, in a sense, if we're data dependent, that's the uncertainty over here. That's the repricing of the market that we're seeing. And again, just to point out one more time, with all of that new information and repricing, we are higher than when the market was pricing in a 50 basis point hike. I don't think that's something that should go unsaid or unnoticed. Right now, the market is trading higher than it was when the market was pricing in only a 50 basis point hike. Maybe the market thought that was a bad sign from the Fed. Maybe the market thought that if the Fed is only able to hike 50 basis points, that it would say that, well, the market can't take the tightening. I don't really know. I'm just making assumptions or talking it out, trying to get a feel for it. The merge wound up being nothing more than nothing thus far. Let's take a look at some positioning over here, first on Ethereum, then move over to Bitcoin, and it's been quite choppy. Do you remember, everyone or anyone who was watching what was taking place on this live streams last week, coming out and before the breakout, right? Coming off the nice trade and then picking up downside trades over here. I'm going from left to right, but you got to come with me. And then I was saying, well, you know, knowing my strategy, knowing that the win percentage is roughly, well, I have to say on Ethereum, it's much greater than on Bitcoin. It's close to a 50% win rate on Ethereum. It's a 35% win rate on Bitcoin. But my expectations mentally, psychologically, you put yourself in a greater position if you assume that 2/3 of your trades are going to stop out. When you're going through any type of chop, you're going to feel a lot more comfortable. You already have those expectations. Coming off back-to-back wins, I told you my expectations that, well, most likely we run into a little bit of chop. And that's what's happened since on both the buy side and on the short side. It's been choppy, and that continues. And the warning went out already. It might continue until after next week's FOMC. Now, it doesn't always happen like that. Sometimes this inside information is shared. I would like to say it's shared because sometimes you see really extended front running of these high impact news events. I imagine that people in dark rooms with cigars, they have information that's talked about and acted on, you know. But nevertheless, we're able to navigate the best that we're able to do with the information that we have. That's why we have the charts. That's why we have our hive mind. And we can see that still, as we put in this trend line over here on the right side of the chart I'm looking, right? We still have held that structure. It looks vulnerable to a breakdown, and a breakdown would lead towards over here, this next trend line, a break of support over there. And that's when we could see some extension down. Be prepared. That could happen next week. That could happen after the FOMC, right? And that could take us down towards, I would say, somewhere around 12,500. That's a massive move. It's about a 20% move. I'm just pointing out the downside risk. Structurally, this is still bullish. From the descending wedge breakout, we have had a breakout, a retest, resumption, higher high, coming back in, taking out that low. It's choppy. We were looking for choppy, but you could see that the descending wedge breakout still held. We resumed up, made a higher high again, coming back down, and you could see structurally that we're now potentially making even a higher low. So this has a bullish twist to it for sure. And then I'm pointing out the risk on the downside. And that's how we do it. Looking like risk is forming some bear flags. And just to go at, like, Rob, yes. The way that I do it is I focus on this trend line over here. Because if that breaks down, but if you go ahead and you add this in, or whether or not it's that little bit of a megaphone type looking bear flag, or you just keep it off of here from that. I mean, yes, it looks like a bear flag, but just for my simplicity's sake, without trying to name the pattern or anything like that, I see that this is potentially a bearish continuation pattern. The trend is to the downside, and this right here is the signal, right? That's the signal over there. Bitcoin, similar situation, a little bit less choppy. So does it make sense that Ethereum has been so choppy when we talk about the merge that just took place overnight from proof of work to proof of stake, the uncertainty surrounding it? Sure, that makes sense. That does make sense. From my standpoint, it was just simply put back to back wins. I'm expecting some chop. Both worked out the same. It's a little bit cleaner here on Bitcoin, right? Move to the downside, breakout of the pattern, a buy entry that why it went into profit wound up getting taken as a loss, didn't go anywhere for myself, and now positioned here on the short side, but technically it's still kind of holding. It's holding in there by a thread. Not only is it holding in by a thread, you could say that technically the breakout of the descending wedge has now just seeing a retest, and that retest is so far healthy. It's holding into the area of support. We're neutral. That's where we are. We're neutral, and you could say, well, Jordan, we're in a really strong downtrend, of course, right? But structurally, so far, the bottom is in June, and I'm looking on a swing traders time frame over the past few weeks, and this is that extension down after the run up off the June low, extension down, and let me go a little bit slower. I went a little bit quick over there. There's the June low, the extension up, came back in now for a retest of those lows, broke out of a bullish pattern, right? This is a bullish pattern breakout, and it's barely hanging in. And then I could say, oh, seems that we're getting ready for even an extension down further on this technical. So we're neutral. That's the way I see it. So I think it was so far a spectacular session. If anyone has the opportunity here, just take a second to take a breath and really light up the thumbs up. That would be greatly appreciated. I'm just playing my part by reminding you. Yeah, Nick, thanks, brother. I appreciate that shining light. That's really beautiful. Reza, really happy to join the session after a long time. Hope everything's great with your family too. Thank you, my brother. Thanks for sharing all the free and valuable info and experiences. Thanks for being here and adding to it so much and all the time. The chancellor on the brink of bailout. And then we also see that they are looking to also put the squeeze on the energy sector, as they call windfall profits. If you went ahead and spent a massive amount of time and energy, capital, and invested into projects that took a long time to all of a sudden produce fruit and see profits, going through massive uptrends and downtrends, and then all of a sudden, when things line up in your favor, and then the government is going to go ahead and take all of that quote unquote windfall profit, are you going to be more willing to go ahead and continue to put that time, talent, and resources towards future exploration and production? I don't think so. I don't think so. I think that as we look forward, things are getting very, very dicey. Fed funds can't be too high. Servicing our natural debt will absorb most of our budget, and grist for the lil. I agree with you so strongly that is my prevailing thought. That's my prevailing thought. And then at the same time, because of that, that's where I have to give the most thought into whether or not that is correct or not. I'm trying to find the chart to where everything's break. Let me pull it up right here. I thought I had it. One more time. There we go. There's only so far that the Fed could raise rates, because as they continue to raise rates, when we talk about servicing the debt, we're talking about the interest and interest alone. Now, how far could they raise it before that interest payment, let's just talk round figures, becomes $1 trillion a year in interest alone? From that type of simplistic reasoning, you would say that, well, they can't raise them too far. Now, the whole thing is, I don't know what their incentives are. I don't know if they're genuinely trying to actually cause some type of shock and send us spiraling into a recession in order to really bring down these inflationary forces by simply crushing and stifling demand, even if that means bringing us into a depression, just so that they could say, look, loss of credibility. No, we run the show. We're in control. That's the pushback to that. I embrace that same line of thought that they could only raise the rates so far, because at that point, the debt will become unserviceable. I guess the one pushback against my own line of thought is, well, what happens if that, again, their incentives are different? We never know for sure. So I think that's a great session here this morning. if you're watching this today on the replay and you enjoyed being here, if you enjoyed the time that we spent together, please let it be known. Thoughtful comments are always well appreciated. Really grateful for them, and I will respond to them. And at the same time, just the simple hit of the like button is a lot of love. Really would like that and appreciate it. Yeah. So that's an interesting thought, Crispy, and a good one, and one that probably needs to be pondered on for a while and a long time. So the reason I say that though is that's when maybe we should pull up a chart of the balance sheet to get a better even view of what that looks like from 2008. And Crispy, what's interesting about this particular time, I remember I was young. This enormous passion for the markets that still has not ceased to this day. And no, I was going back even further. I'm sorry, I was going back over here towards 2023 and when the Fed didn't cut rates and why I told my friend, my partner, my buddy that I would go ahead and teach ourselves the markets. We didn't have these resources that are available to today, what's taking place here right now and across the whole World Wide Web. And I remember that I was saying it's really interesting that the Fed hasn't lowered rates or raised rates rather. And I think that means that they're going to be the U.S. is going to be looking to go to war. And it happened anyway. Don't worry about that. This is what Crispy is focusing on, 2008, the great financial crisis. And that has begun, as you could see on a log chart. Let me put on a log chart. That is a log chart, and you're looking at the incredible, massive expansion of the Fed's balance sheet, which continues. And it's my thesis. It is my whole, let's say, every single investment that I have now and will continue to have is because of the central banking system, the debt-based fractional reserve system that right now the Federal Reserve is the center stage of. And if you look at their balance sheet, it continues to grow. And because of it being a debt-based system, there's only enough of them dollars out there. And right now, we could see we're moving towards why there was an abundance of them over here, less and less dollars being available. Those dollars are needed to pay back the debt, right? And there's more debt out there than there are dollars. That's why the system is not sustainable. When we talk about monetary reset, is because there's no way, as the system's designed, that it could just go on forever. So that the way I look at it, the Federal Reserve right now, that might encompass obviously the Bank of International Settlements and the whole central banking system together as a whole, are trying to buy as much time as possible to go ahead and to continue to milk this current system that benefits them, not us. The system is designed to take money from one group of people, and that's everyone, and then redistribute it to the very few and whoever they are. And it's brilliant, and it works out very well. If you've not seen or not heard of the book, The Creature of Jekyll Island, make sure you watch it. You could watch the Money Masters, and it's called, I have to find it tomorrow for those that prefer video format. It's only like a 15, 20-minute video, and it talks about what happened on Jekyll Island, how Morgan and the most powerful bankers of the time met in secret, and they wrote the Federal Reserve Act that was passed December 24th, Christmas Eve, with only a few members of Congress or the Senate present. And it has worked out flawlessly in their favor ever since. And I think that they want to keep and continue that current system going on as long as it could before they're able to maneuver into whatever the next system is. We have pushback from the rest of the world right now. Though the system that this does not favor, those in Russia, China, India, Brazil, Saudi Arabia, we're seeing people around the world jockeying for position in trying to form a new world order, a world order that's going to be more beneficial to them. We're seeing monetary reset happening, but during that process, these cycles are getting shorter. We could look at monetary expansion happening, right? And it took many years for them to start tapering the balance sheet, right? They were going to taper over here, and then no, there was the taper tantrum, and then balance sheet expansion further, and then they're tapering up here, and finally they tapered. And then there was a long time before they were able to start running QT. And then things broke, right? Things broke right here on September. Reverse repo market, overnight interest rates spiked. Fed had to begin balance sheet expansion. Risk was trading significantly higher when the market broke. This is things breaking. This comes back to the beginning of today's session. This right here is things breaking. Risk is substantially higher here than it was going back 9 months earlier in January 2019. So when we talk about they're going to tighten to things break, and then you hear people that have been in the markets for 18 months and are really good at Twitter. They're really good at it. They're really good at getting communication across. They're really good at, getting that type of interaction, and people start paying attention to them and to what they say. And they sound smart, and they are smart, but sometimes you can't make up for experience. 9 months later, risk trading at new all-time highs, things broke, balance sheet expansion continues, and then markets continue to begin now melting up. And don't forget, it's not over here until things break again. When the market broke over here in the low of March 2020, the bottom of March 2020 was higher than the bottom of December 2018. That could happen again. That could happen again. That June low that we've seen in the equity markets, 2022 in crypto, that could be gone next week after the FOMC, or the week after, or soon thereafter. Or that could be the structural low. We don't know. There's nothing easy about it. Balance sheet expansion continues, and then it was much quicker until they're able to start running off and tapering those asset purchases. And then you could see they didn't have to even level it out. They're trying to start QT right now. It's expected to pick up in the months ahead, starting this month and forward. It's expected. We'll watch and see if they're able to do it or not. There's different lines of thought, but you can see that the cycles are getting much quicker. And I expect that they're going to continue to get quicker and more violent until this system is no longer, and there will be a new system. That is where the Great Reset comes from, 2030, because monetary reset is happening, and all different interested parties are trying to make sure in whatever that new system that evolves is, that they have the position of power. That is our session for today. I hope you all enjoyed it. I know that I did. Thanks for being here. Thanks for spending time. It's a true pleasure, a true joy. If you have the opportunity to share this with anyone today, anyone who's interested in the markets, if you would take the opportunity to share this video with them, let them know what we're doing, that would be greatly appreciated. I'll see you all tomorrow for Friday. Have a beautiful day, everyone. God bless you, and I'll talk to you soon.